Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Well, look who's in the podcast today. We got a cast of characters. We have the governor of the great state of real estate here in Texas, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. Getting ready for summer and on a bunch of trips. So looking forward to recording a podcast before we get out of town.
That hot weather is starting to come to Texas. And so I can't wait to see you in your Speedo swimsuit coming up here, hanging around the pool here in Texas.
A sight to be seen, I'm sure.
It is a sight to be seen, but another sight to be seen is James, the Professor Eng. James, how are you?
Good, Paul. Thanks for having me. Still trying to work on that imagery.
It's burned into my eyes. We just had Old Capital Speaker Series that came up last week or so, and we talked a little bit about capital calls. And if you didn't have a chance to be on that call, we recorded it for you. And James, just talk a little bit about the high level about that call and what you thought was important for people to kind of think about.
Yeah, I mean, some of the stats that Neil Bawa mentioned was that essentially like 9 out of 10 syndicators out there have never done a capital call. And most people are coming into the capital call thinking, all right, I'm going to send an email and all the money's just going to come flooding in. And most of these capital calls are failing based on just sort of a rough sampling, probably 60 to 70% of capital calls are failing. And there are ways to improve your chances and prepare yourself for these capital calls. So we had about 100 people on live. We probably had 200 or 300 people watch the video already in the last 2 days. And it really gave it from the point of view of the general partner, but it also helped a lot of the limited partners who are on the call understand what questions they need to ask before putting money back into the deal or getting diluted, making sure you understand sort of where the money's going to go. So if you are not on our email list, get on our email list and we will send you that recording.
Yeah, I thought it was a great recording that was done because we saw a request that came out yesterday that hit all 3 of our inboxes by somebody that we know that was asking for money that I kind of thought was a joke, because they were just saying that we need this much money. And Mike, what was your 2 cents on that capital call that said that was not a capital call?
Yeah, they were secondary funding of a deal that closed 15 months ago or whatever. But our interest is up and we got to buy a rate cap. And I was like, man, there's 0 chances we're going to work. So thought it was very poor presentation. Felt like they tried to cash call their group and they couldn't be successful. So now they're going to try to raise some third party money.
Yeah, it wasn't very well done. And so watch Neil Bawa at the Old Capital Speaker Series and see how he says to put the spin on it. You've already sold these investors one time, and now this is the opportunity that if you need cash to come into your partnership to keep the transaction alive, survive to 25, as we say here at Old Capital, is that create, fund your partnership, additional cash the correct way. And Neil, I thought did a great job. So, James, one more thing. Tell me a little bit more about when the Old Capital Conference is going to be.
October 4th and 5th here in Dallas. So Wednesday and Thursday. A happy hour the night before and then Thursday all day. One of our favorite analogies is getting on the airplane and making sure that you got your pilot, co-pilot there, and all the guys, whether they're in first class, our preferred equity friends, or common equity and coach. We're going to make sure that if you take the plane off, one of the quotes that I recently saw was from, I think, the original Rich Dad. He said, takeoffs are optional, but landings are mandatory. And so we're going to make sure you land the plane this year or next year.
Safely. No doubt about that. So in the podcast today, we have one of our friends that sells a lot of real estate. In fact, I just saw a flyer that came out yesterday from his team here in North Texas from Marcus and Millichap IPA, that said that they have either under contract or have closed over $1 billion in multifamily properties this year alone. So that was really amazing that what these guys have done. So in the podcast today, we're going to talk with Joey Tumminello with IPA. That's the Institutional Property Advisors Group within Marcus & Millichap. He is based out of North Texas. He's out of Dallas. And he is the guy who a lot of the institutional people talk to, whether they want to sell properties, they buy properties. That's kind of our canary in the coal mine about what's going on with the institutional buyers. Are they buying properties? Are they selling properties? And so we're going to talk with Joey to kind of give us a better idea of what's going on. So I'm going to throw it over to Michael. Let's talk with Joey.
Joey, thanks for coming on. Appreciate it.
Thanks for having me. I was looking back the other day and I was thinking last time I was on this podcast was the day after LSU won the national championship in 2019 for college football. And so a lot's changed, both optimistic and some pessimism since we were last time. And you're the governor, not the mayor anymore, which is
well, you're probably not super hungover after celebrating the Natty the night before too. So that'll probably be helpful. But yeah, so as Paul mentioned, you work with IPA. We personally done a bunch of business together. I don't know, dozen, 15, 20 deals, whatever we've done together, buying, selling. So know your firm well, but for those that don't, maybe kind of give the brief introduction about who you guys are and what you do.
Sure. Well, yeah, I appreciate being on the podcast this afternoon. I'd say, so myself, Drew Cowell, Michael Ware, and Taylor Hill, we lead the IPA efforts here locally in Dallas-Fort Worth. As Paul mentioned, we've done about $1 billion in sales this year, which coming into this year, we were a little bit pessimistic as to actually how that's going to turn out with a lot of the geopolitical noise and potential interest rate movement that would continue throughout the spring and into the summertime. There's some things to be optimistic about in terms of where we are in the market today. But, our focus every single day is Class A and B multifamily investment sales. We spend 100% of our time in Dallas-Fort Worth, and we sell about, 40 to 50% of the market share here locally, especially the upper echelon, the multifamily space. But we have a wide book of business, and it's an important time of the market to make sure you're diverse and touching all your clients up and down the spectrum, because clients' needs are changing every single day right now, as James mentioned, talking about capital calls. And as institutions re-enter the market, it's such a dynamic time right now as the market continues to ebb and flow, and watch what's going on in terms of the headlines and how the market continues to change.
Yeah, so when I saw that $1 billion number, I was a little surprised it was as high as it was, because it seems like volume market wide and more so on the lower grade is probably off. 75%. Like maybe you're doing 25% of what it was, and say 21 or 22. Does that feel about right? What did you guys do in volume roughly for 21 or 22?
Yeah, so in 2021 we did 5.1 billion in sales in Dallas-Fort Worth. And in 2022, we did 4.7 billion. And so to get to one, we're excited, but obviously expectations have changed both from a managerial perspective and just a personal expectation perspective. So, as we kind of weave through what can we really get accomplished through the back half of the year, we think summer's going to be relatively slow. But as you look back in the first, we sit here on May 19th, you look back the first 5 months of the year, and there's been about 30% of the inventory that's come to market in terms of historical annual numbers of multi that we see hit the market for the first 2 quarters. And that's telling. There's been Wall Street Journal articles about that for the entire country in terms of multifamily sales. But thankfully, we're back to this market where Freddie and Fannie are the primary lending source. And I think that's a true difference maker in terms of just capital solutions in general relative to other product types that have to rely on CMBS, bridge, and commercial bank loans. Just in terms of, usual options and spreads on those, it's tough to make deals pencil right now. So we're really thankful to be in the market we are and have the liquidity that we have from all sides of the capital stack.
So I know it is varied by location and grade, but I think maybe you could talk a little bit about kind of cap rates. So cap rates generally have expanded, but probably not as much as most casual observers of the multifamily space might think. What's kind of your newer Class A kind of cap rate range? Are you seeing these deals kind of clear on a trailing basis right now?
Yeah, so to take a step back, I'd say historically, if we look back in the last 12 to 18 months, cap rates for any deal that we would review would be in the low 3s, walking in the door, tax adjusted. With a little bit of modest trended rent growth, you're getting to a high 3. And this is all through 2021 and the beginning of 2022. Fast forward to today, those cap rates have expanded between 125 and 150 basis points. And I think the biggest difference, Michael, is that there wasn't any sort of arbitrage between A, B, and C product at all. It was just market growth was 15 to 20%, depending on the location and product type, and everything was explosive. Now taper that down with this reversion to the mean that we've seen over the last 18 months. I'd say Class A cap rates are in the mid to high 4 cap rate range, walking in the door, and with that same trended rent growth of really people trying to get to positive leverage in year one. So what does that mean? If someone's trying to get to a 5.25 cap year one, but their day one debt with an agency loan at 60% will probably be in the 5 to 5.25 range. So you have to anticipate you'll see some sort of rent growth, either manufactured through a value add program or organic through a top echelon property that's best in class amenities and location amongst its competitors.
You sell some B and really don't sell a ton of C, but what's your sense of for comparison's sake, what would a B or maybe even like a 70s or 60s vintage deal, what kind of cap rates are those clearing out right now? There's not a lot of volume, so it's probably not the biggest sample size.
Sure. Well, I at least feel like we have a bracketed range that we can do business in. So if Class A cap rates are in the 4.5 to 475 cap rate range, I would say your 70s and 80s in the product in the lesser locations are 5 to 5.25 tax adjusted. So you do have the arbitrage top to bottom, where keep in mind 2 years ago you didn't. Everything was a 3 cap and it didn't really matter. So people who are searching for yield and going down spectrum, there's more risk that comes with that today than did the last couple of years, because we're starting to see more collection loss appear. We're starting to see more modest rent growth. And you all know this, but taxes and insurance are really beating our clients up. Those tax numbers just came out within the last month, so everybody's going through the protest process. But, with more modest rent growth and the expense expansion, that's becoming really challenging.
Yeah, perfect. So what I'll turn it over to James here in a second, but like what do you see right now? Why are buyers buying and why are sellers selling? What's kind of the motivation to transact right now?
Sure. So I'll start with sellers. I'd say sellers who have the widest margin to be able to transact right now are developers who build suburban product in the last 3 years. Most of these assets that they've time to sell about now, they built for 160 to 180 a door and are transacting in the, I'll give you a range, but 240 to 260 a unit. And that's still north of 20%. It's not a home run, but it's hits their IRR threshold, and there's enough margin for them to make money in a timely fashion to get into a promoted position. As you go down spectrum, I'd say the other sellers who are also looking at different opportunities right now, they're saying, okay, we're probably 20% down from peak pricing April last year. If I bought an asset 2015 to 2018 and have an agency loan on it, either that loan can be assumed or it can be prepaid. And I still have plenty of margin based on the run up that we saw before the pullback in pricing. I would say that's the second tranche of sellers that we're seeing. And the reason they're selling is because they say, hey, if we sell this and maybe it's a single or double for us, we can either exchange or rotate into something that's in the Class A space or higher up the spectrum to get a better asset, better quality in a time where rent growth is going to be more muted, as we talked about. So I think those are the biggest reasons. Where we're seeing people get pinched is folks who have acquired assets since 2019 to early 2021. They put 70 to 80% bridge debt or debt fund deal in place. And as James was mentioning earlier, you're now paying a current potentially 7 to 8% on that this fall. So a lot of people are talking about those that didn't hedge their rate cap exposure correctly. And look, people were just doing the deals that they could at the time. So it's no one's fault. And no one thought, we were doing this podcast 2.5 years ago, no one thought we'd be in this position today in terms of where interest rates are starting to settle. Those are the folks that they either have to do a capital call, they either have to try and do a cash in refinance, or they have to sell it, hopefully at par, potentially at loss, with those syndicators out there that can be detrimental to their business. So people are weighing a lot of options and just trying to see what those solutions can potentially be.
And so on the flip side of that, who are the buyers coming in right now? Because it seems like everything you read, it's like institutional equity are their pencils down. So who's coming in on the other side of these transactions? Let's say on option one or seller one, which is the developer, seller two, which is you bought at a good basis in 15 to 18. And now, you've held this thing for 7 years. Now it's time to go. Who's the buyer on the other side?
Sure. So I'd say it's twofold. Number one, you've got institutional groups who are finally jumping back in, have been on the sidelines for 8 to 12 months in some cases. And a lot of these institutions, James, have closed-ended funds, or they've also been fighting redemptions from both domestic and international capital pulling out of those funds as they're seeing potential recessionary fears that we could be in right now. We could be on the forefront of something worse. But a lot of those folks you can buy below replacement costs right now. They're not really as debt sensitive. So they'll either buy all cash, capitalize it later as rates start to come back in, or they'll put modest debt on it at 45 to 50% LTV and can upsize that later in a different environment. So I'm not saying that that's a plethora of buyers right now, but we're seeing it on the examples of our billion that we've cleared the market. And it gives us some optimism going into the summertime and into the fall as a lot of those data points clear, because a lot of people have said, hey, until we see where the market is transacting, we can't be active because we don't know where market is.
Are you seeing any guys come up? Let's say they used to buy B stuff and now there's not as much competition on the A stuff. So they're jumping up and taking down those deals, or is it still, 40% equity raise on an A deal is a lot of money still at 100,000 a piece. So are you seeing any syndicators jump up to the space?
Yeah, I'd say, look, even the best capital raisers out there, or some of our dearest clients, are having a challenging time right now because they're going to different family offices or different individuals in general and saying that, look, I can get 5% in a money market today. Why would I go risk money out there with the lack of liquidity and all the risks that come with investing in real estate? Those groups are still trying to get deals done, albeit at a slower pace. But I'd say a lot of the groups that were acquiring $20 to $40 million assets, who are raising money $100,000 at a time, that model has been a little challenged right now because of what they've purchased recently and going into this environment where there's just less inventory to go try and acquire.
So, Joey, is syndication a dirty word? And so let me say what I really mean by that is what we've heard is some of the institutional sellers that are actually selling these properties, they really don't want to hear too much from the syndicators in the form of guys that have to go out and raise the money versus the 1031 buyers versus the guys that already have the committed capital. You were talking about how difficult it has been for syndicators to go out and write these $100,000 checks or have their investors write these $100,000 checks. And so they can, try to accumulate 10, 15, $25 million to buy a $55 or $60 million property. And on the calls with the sellers, so buyers are trying to get matched up with the seller on the final call to kind of pick a horse in the race. We've heard through some of the listing brokers that don't say that you're a syndicator. Don't say you're a syndicator, because that kind of has right now is a negative connotation, because some people have been led to the altar and then they haven't been able to collect the money. So it's just say you're an operator or just try to define where that money's coming from. What are you advising some of your sellers in conversations?
Yeah, I think that's a great question. I would say I'll reuse the word, for most syndicators who have been out there for a long time, and like SPI, for example, we've done nearly 20 deals with, we frame that to the seller in a different way, that you say, hey, we're going to the same well of folks that he's been raising money from for nearly a decade or over a decade. And so when you look at those options, it's all relative, Paul. I would say you have those groups, you have institutional groups with discretionary capital, and then you also have groups who are coming in trying to provide more affordability through PFC structures, which has been really active this first half of the year. I really think it's all how you frame it to the seller. If there's a syndicator who we haven't done a deal with and we don't know them from Adam, that's going to be a more challenging pitch for us to our seller, because sellers want certainty to close right now. And we used to talk about, think about this 5-6 years ago. It was all about hard money. It was all about how quickly you can go non-refundable contract. Now people just want you to start the clock and make sure that you can close and show up to the closing table.
So you touched on this a little bit, but for guys coming up and maybe they're used to looking at 80 stuff with 8-foot ceilings, and now they're moving up to the A stuff. They go tour it. They see the models at the pool. They love it. But then they go back and underwrite the deal, and they're a little short on cash. So like you touched on, you're buying it below replacement costs. So check, I like that. But what are guys missing as they move up to Class A? Like, talk about maybe the opportunities, maybe some of the stuff that people miss when they're moving up to Class A.
Sure. I mean, most folks who have done so well in the B and C space, it's very capitally intensive. You have to allocate a lot of CapEx from the jump in terms of when you acquire the asset. But as you move up, a lot of that headache is much less so in terms of capital that needs to be raised, in terms of what the angle is on the actual asset. So when I say angle, I mean, are there cable contracts to assume or put in place that we can increase other income? Are there areas where it may not be as intensive, but can we add an additional 10 to 20 dog yards to a surface park asset? Can we put in package locker systems? Tech is definitely at the forefront right now on the operations side of multifamily. And so there's some very sophisticated groups out there that are trying to provide all those things I just mentioned, plus making all the tech one ecosystem, and there's dollars there to be had in terms of premium and rent. Now, what will you know in terms of looking at an asset, or what will the risk be? The return is going to be lower because you don't have as much capital to raise. You're not going to be north of a 15 levered IRR on a 5 to 7 year basis. It's going to be more, in some cases, 11, 12 to even 13% IRR, depending on the life of the hold. So people just need to be cognizant about that. But look, I think right now, LPs, if I'm an LP right now, I want safety and something that's going to get me through the next 3 to 5 years with less downside risk. And I think that provides it.
So you mentioned the syndicator thing. So we actually, this week, I was a little pissed. I lost a deal that I thought I was going to win. That was a pretty good price. And they picked a group that had a closed-end fund, and we were going to have to raise the money. But I own 2 deals in the submarket, but the other group bought a deal from the developer, but the equity I bought a deal from. So I'm not to bitch too much here, but it just seemed like if I would have said I had 1031, that would have been probably the better route. They never would have verified it. So something to that, and they didn't even have hard money. We were going to show hard money, but they didn't have to go raise it. So I think that kind of illustrates your point, like the ability to raise capital. That's of paramount concern, especially to some of these merchant developers out there. So I just kind of drove that point home too. And then the other point to me, and I don't know if you agree or not, it feels like on the nicer stuff, that deal was below current replacement cost. They would, it was way off of where they wanted to sell it for, but it felt like they were, 10 or 15,000 below current replacement costs, even though, like you mentioned, they had probably 20, 30,000 a door and gross profit because they, set the deal 3 years ago with land costs and lumber and all the other things. So it feels to me like in Dallas Fort Worth, at least, and maybe Austin, we're kind of approaching maybe a floor here of the newer Class A stuff. I don't think that's the case on the workforce housing, but it seems like the Class A merchant developers are like, this is about as cheap as you're probably going to get it. And it seemed like me and the other 2 groups they were pretty freaking sharp and sophisticated kind of players. So I don't know if you have a sense of kind of like, are you feeling kind of like we're getting there? Are you feeling a little more slipping, or, I don't know, what was your kind of sense on pricing in the next 6 months?
No, I think we definitely have our footing in terms of the bottom of pricing relative to the last 6 months. So I think about what we've gone through in the last 13 months. November, December felt like max volatility in terms of the assets we had in the market because people were so unsure of where they could get debt to put in place. And so now we've had, myself and our competitors have had data points that are out there that both institutional and private acquirers of multifamily can look at, compare and contrast, and say, okay, if we want to be competitive, here's where we need to be. But if we're not going to be competitive right now, then we might as well just continue to monitor the market. But yeah, because I don't think any lower than this, call it 220 to 260 a door range where these suburban garden deals are trading right now. I don't think the developers or sellers any lower than that. I think they decided to refi, get off their construction loan, and kick the can down the road. So if we want to see the market continue to move, we can't have any additional diminishing pricing.
The other thing that would be sign for me, the Class A stuff, and workforce is a different animal, but would be, hey, some big institution buys a portfolio and it's like, oh, then they're all kind of sheep and they all, like you said, realize that this guy did this. And so I saw, it's not exactly apples to apples, but I saw a headline that Nuveen bought a 12,000 unit affordable portfolio in New York City. And it's like, okay, are you seeing those guys dip their toes in here lately, or because they were just all pencils down? But are you, without naming names, are you starting to see some kind of green shoots from the institutions buying?
Yes. So I'd say of the billion that we've closed, 30% of the buyers have been institutional. And they're those groups that haven't bought a deal in close to 12 months here locally. So here's my thesis on that, Mike. I think at the beginning of the year, some of the largest institutions in the multifamily space were selling some of their older assets, 80s, 90s, and early 2000s vintage product. And a lot of these deals, whether they were loan assumptions or all cash potential purchases, had in the neighborhood of 40 to 60 offers on the table. And I'm just referring to Dallas. So if I'm them, and look, I'm just one guy out there who's monitoring the market of many. If I'm them and I see the market starting to gain footing and I have my back door solidified in terms of where my capital is coming from, why would I not try to go participate if I see the market's going to be on the rise from the jump? It can always get worse, and there's always the downside risk component. But if I'm a believer in basis, there's no better time than right now to go buy a multifamily deal, as long as you can live with the debt. So in my career, pretty much every year, assets have been trading well north of replacement costs, and everybody's been preaching about basis. Well, this is the time to be active if you really wanted to take advantage of that.
Yeah, I mean, I just pulled up the 10-year Treasury and like what you're saying, like essentially 10-year Treasury went on a run here starting probably September of last year, and it sort of has traded in the range of, let's say 3.30 to 4-ish, probably on the lower side of that. And so that, I think that's helped a lot of people to sort of dip their toe back in the market. If I can underwrite a 525 sort of fixed rate Fannie Freddie, then I can price this type of stuff. It's only when, to Mike's point, like the only challenge would be if we just see interest rates run more, right? If the Fed doesn't stop, if the Fed doesn't pause and they just keep going and 10-year Treasury keeps running, then on your Class A stuff, they're going to have the same problem, right? They're okay, I think, coming in at 50 to 75 basis points underneath their debt, but you can only do that for so long. Right. So if the debt keeps running, then that's the problem.
Exactly. I've said this a bunch. I think we're at a key inflection point of if the Fed continues to raise rates for another couple of quarters, then it's going to be really challenging to acquire assets, especially in the value add space where a lot of that's tied to SOFR and a massive spread over it. So the big thing that we've seen people pivot to in terms of debt placement is the agencies are going to 5-year money right now, because everybody who is in the real estate business, groupthink or not, believes that rates are going to come down in the next couple of years. Whether it's next year, 2025 or after, I don't have a clue. But everybody believes that. So that's why the 5 and 10 year are almost married to each other right now in terms of the all-in coupon. So that to me gives you more flexibility in the short term where, I mean, y'all remember, because you did a lot of this little capital 3 to 4 years ago, a lot of people weren't matching their business plans to the execution. They were doing 10-year fixed rate money and everybody thought those guys were stupid. But the reality is those are all the ones that are really still smiling right now and really smart.
Yes, they are. Yes, they are.
Yeah.
So Joey, you work in the space up in North Texas with Marcus and Millichap, IPA. But IPA does not have offices all throughout every Marcus and Millichap office. But the people that you talk to within the IPA system within Marcus and Millichap, whether it is South Texas in terms of Houston or Central Texas in terms of Austin, San Antonio, or outside of Texas, what are some of the other things that you're hearing from some of the people in your position? What are they active? What else are they hearing from? What you have any inside information about what some of your people with IP are saying?
Sure. I mean, my counterparts in other markets and where we have, I'd say, similar market share is all in the smile markets across the country. So from the Pac Northwest, all the way through California, into Phoenix, Texas, Florida, and up the East Coast in some sparing markets. I would say this, I'm super thankful in terms of the market that we're in today, because while Phoenix, you could argue, was the most explosive market in the last 5 years, it is completely reverted, and the rent growth has shut off in terms of where it has been running the last 5 years. And when I first got into the business, New York, California, all these coastal, very sexy markets, for lack of a better term, were all trading well inside of Dallas. We were in 5 cap territory. They were all in 2.5 to 3.5 cap territory. Now, other than Austin, really, we are the tightest cap rate ranges in the country right now, in this mid to high 4 cap range. And Austin trades typically about 25 basis points inside of us at a premium. So how long does that stay in that shape in terms of, does that evolve back to what it was, or does regulation and other political things keep that as the new status quo? That remains to be seen over the next couple of years, an election year next year, and a lot of things that could change that.
When you guys look at one of the things that people always comment on is Dallas is the number one freaking market for apartment developers, and a lot of units are coming online. I guess it's a two-part question. One is, are you seeing new supply hit in certain submarkets that is impacting lease ups or just going down that food chain, right? So maybe it's not hitting maybe the new stuff, but then the guys that are like maybe the 2000s construction, the 2010 construction, that stuff is okay because there's a big enough gap. So maybe touch on new supply, because from the outside, it seems like everybody is just like, if it's 2000s or newer, it's just, they just call it an A, but maybe differentiate between some of those.
Sure. So to answer the supply part of the question, I mean, there's 70,000 plus units under construction right now in DFW. That scares a lot of people when you say that. However, you really have to dig into it submarket by submarket in terms of where are the deliveries, how much is delivering in the next 2 years, as opposed to what's already delivered and stabilized now with how they track the data. And it hasn't completely inverted, James, but a lot of the supply that has been delivered in the last 5 years, it's been in all the primary heavy headline driven markets. So Plano, Frisco, Richardson, Allen, primarily a lot of the North Dallas submarkets, and multi-phase projects that were all completed as well. Fast forward to today, and now every developer that we do business with, and we've done business with most of the national developers and a lot of great private developers who are based here locally, are going much further out to Weatherford, beyond Mansfield, southwest of us, beyond 380 north of Frisco and Salina, Melissa, Anna. And so those are the next rings a lot of people have never even been to. And you've got a couple thousand units in each of those submarkets. The takeaway, though, that's so important is I'm a firm believer supply not going to come to a halt, but it will be a dramatically different number next year, because every single developer we talk to, their quote typically is, hey, look, if we do 8 to 10 starts annually, if we do 2 to 3 starts in 2023, we would consider that a home run. And it's really challenging right now. They can't get construction loans because of the credit crunch that we're witnessing both in real estate and in other disciplines of investing. And that's one big challenge. And also, like what we've talked about on a more macro scale, equity is very skittish right now. So they want to make sure you get costs in line. And oh, by the way, we're trying to capitalize projects of where these existing sales comps are happening right now. So that's challenging to lean into as a developer who needs to go build something for $230 a door and sell it for almost $300 a door. They're in a tough spot right now.
So maybe I walked too many B and C properties, but like all I know is 80s deal with an 8-foot ceiling and a 90s deal with a 9-foot ceiling, and the 90s deal has some washer dryer connections. But outside of that, like, is there any differentiation between your 2000 product, your 2010 product, your new stuff that's hitting right now? Like, if someone didn't tell you the year built and you just walked in the door, could you tell a 2000s versus 2010 or a 2020? Like, is there anything besides just that when you walk a deal, there's something in there that the tenant feels that's different in those gaps, in those age groups?
Yeah, so it's a good question. I mean, I would say developers put so much time into the aesthetics and the first appearance in terms of your first intro when you walk into a clubhouse. most of the deals that we worked on and walked hundreds of them built in the 70s and 80s have small clubhouses, have the 8-foot ceilings, as you mentioned. All of the leasing is just 2 desks right in front of you. And the gym is incredibly small with a pool. It was an afterthought and maybe a pergola. The new construction assets, it's an overused term, but everybody says we have a Vegas-inspired pool, massive pergolas, huge furniture in the pools, and they're very expansive because on weekends they know what happens out by the pool, and that's a huge amenity. Gyms are state-of-the-art, double volume in terms of the space with cardio rooms upstairs, more strength-based training downstairs. And you walk in and you've got just a massive first appearance relative to what we call a postage stamp clubhouse for 70s and 80s. That's the biggest difference. A lot more product today. If it's 4-story, it's always going to be elevator served. And some of the product built in the 80s didn't have garages at all, where today, most of your service park assets, you get for a 300 to 400 unit deal, 200 to 300K in annual income and parking income. So you cap that value and it's very significant, on a $100 million asset. So I'd say those are the biggest difference. And then the tech things we touched about, a lot of innovative people are implementing tech in some of the older vintage assets they're retrofitting. But, to be able to do it from the jump when you're a developer is a lot easier and do it yourself.
Mike, the dirty word this month is property taxes. Property taxes, valuations, assessments have come out. And what is your group over at SPI doing besides crying?
That was last month's dirty word. This month was insurance.
Oh, yeah.
But both are a challenge. Honestly, it was friggin' ridiculous. They went too far. It seems like there's going to be quite a big reduction at the ARB appraisal review board level. I mean, a good example is we bought a deal that we were still protesting 22 down in Bear County. 22 taxes. They had us at the purchase price, and which we think we're going to knock that down 15% from there through the kind of final protest, and then they went up another 10+% from the purchase price. So we closed the deal in late 21. So how could you argue that a deal that you purchased towards the late 21 it should be taxed at 10% above purchase price? That just seems absurd to me. So I'm sure we'll get that knocked down to purchase price of the ARB and then go fight it out. So it's just the ones who are winning are all the tax consultants because they're going to get their cap on every single deal this year. So whatever the cap is, they're going to hit it. It's just utterly absurd. And then insurance was tough. I mean, and North Texas were 20+%. Somewhere I don't remember the exact deal, but somewhere north of 20%. Paul was the increase on the renewals. And thank God we don't know stuff in Florida and Houston because God knows what that was. Or if you have a chiller deal, a 60s chiller deal, I mean, those deals are $1,000 plus. Paul, James, have you seen any of those go through? Over $1,000 were $900 to 5 years ago that would have been $250, $300.
James, kind of talk a little bit about that because insurance, when we just 5, 10, 15 years ago, we used to underwrite them with $350 annual a door for a Class C plus property. And then what are we underwriting today, James, for a Class C, B minus, B property or for insurance?
Yeah, I mean, at our speaker series, I asked Jeff King that exact question, and I just used the 80s deal. And he said in Dallas, probably $700 to $800 a door. And then if you go down to Houston, it's double. So $1,600 a door down in Houston right now.
Yeah, it's very difficult to pencil these transactions out where your property taxes are high and your insurance is sometimes even higher to whether you're doing an acquisition or you're trying to refinance out of a bridge loan. It's what you originally had taken in, what you thought was going to be there at $350 or $400 or $500 a door. Now it's $750, $1,000, but try to shop that insurance around, regardless if it's in Texas or you're buying a property in Arkansas or in Indiana or where we're at. What I'm leaning to is really to Joey about when you guys are selling a brand new property. I mean, how are you, when you guys are underwriting these deals, how are you kind of valuing these insurance and the taxes? Do you guys go out and talk with a property consultant to kind of figure out where property taxes you think are going to be on this property for the step up? Or do you, how do you get your data when it comes to underwriting to sort of put in the offering memorandum on behalf of the seller?
Yeah, so for taxes, we don't go out with an asset unless we've had a discussion with the property tax consultant. And typically we actually have that in the deal room. That's immensely helpful, especially during this time of year, understanding initial R values. For times like this, it's challenging in terms of we just called for offers or we're going through a best and final process and the initial values just came out because even though Freddie and Fannie do a ton of business here on the lending side, they have to honor what's in place on paper. And so nothing's going to be written down until July 4th. So buyers who are trying to acquire something right now either have to go all cash, which only certain people can do, or they'll have to go. Typically, life companies will work with you as well, more so than agency lenders will. So with that in mind, those are the biggest things. We never put in an offering memorandum because since we're non-disclosure state, all of our offering memorandums just grow taxes by 3% so that we don't provide a trail of crumbs for any sort of tax assessor. And then insurance, we joke about it, Paul. I mean, it's not a joke, but 7-8 years ago, we would just plug in $250 a unit and forget about it. And we never had to worry about it. But now it's a completely different environment. So we've had more discussions with insurance brokers than I've ever had probably in the last couple of months. So we're underwriting, we just called for offers on the deal. And I asked every single buyer what their insurance number was, shy of 300 units, newer construction. And the insurance numbers range from 700 a unit to 1,200 a unit. So you just got to make sure somebody has that nailed down and has had updated quotes before you move forward in the process.
One thing I wanted to throw in there too is just make sure you have those loss runs before you go hard in those transactions.
Yeah.
Right, Michael
Yeah.
Becker?
Yeah.
So Joey, touch on, you guys obviously have a lot under contract. Maybe tell us sort of roughly, these deals are coming out. They're on the market for 3 to 4 weeks. What are you seeing in terms of tour activity and then offers in terms of percentage of whisper price? And then once you get the best and final, is it like, how much movement are you seeing after that part?
Yeah, I'd say market activity wise has been really robust because the lack of inventory recently. So any given deal we bring out is going to have 30 to 50 tours and 15 to 20 offers with probably 5 or 6 groups in best and final. I'd say those offers are where we end up are between, plus or minus the strike price, because I feel like the market's reset enough to gather, hey, where we were, where we've been, now where we are. And in terms of the activity part is not that is the easy part in terms of where we end up from a best and final movement perspective. I'd say your average move in best and final is anywhere from 2 to 5%.
Got it. All right. Let's go around the table. Just ask a final question here to let Joey go back to the office and make some pennies. Go ahead, James.
My question, and I'm waiting for this, and I'm seeing it probably more on the B and C side, is I'm waiting for that first deal. We saw it a little bit on the C side in Houston, basically to close at or below the loan amount that was done in 21 or 22. And do you think that will come on a Class A deal in DFW, if that makes sense? So bridge loan at $30 million, and then it sells for 29 this year or next year.
Basically, the loan's called, yeah. It's hard for me. No, I don't think so. Not in this market, because I feel like the market has already been reset 20% from where we were. And so I think, and then rates have continued to move last couple of months, and the Fed's been adamant about that. So, they raised rates 10 times. And so even with that, we've still seen the market settle in this cap rate range where we can actually do business. I don't think that will be the case in the short term.
All right.
Sounds good. Michael, any questions before we say goodbye to Joey?
No, just maybe, Joey, how can people find out more information about you guys or get on your distribution list of new deals that you bring out?
Sure. I'd say for anybody who like what they heard and want to hear more info and see our inventory, feel free to reach out to myself or any of my colleagues, but email is easiest, jtumminello@ipausa.com, and then we'll put you in our system for the state of Texas.
That's fantastic. So great information from Joey over at IPA up in the Dallas office here. Again, numerous offices throughout the country, but Joey and his team do a great job in the kind of the center of the universe for apartments of Dallas, Texas. And so thanks for joining us, Joey. Certainly do appreciate that. James, always a pleasure. And again, not to put a bad image in your head or a good image, can't wait to see Michael in that Speedo coming to a swimming pool near you. So looking forward to seeing Michael at some period of time. So again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.